Hey everybody, thank you for joining me for today's end of day review. And in this video, we are going to review the Emini 5-minute chart for Thursday, November 13th, 2025. Whenever there's a big gap going into the day, I check out the Globex chart. And typically I'll look at the Globex 15-minute chart. Here's the context leading into the day. So pretty wide trading range through here. Several legs up, but big swings down and up in both directions. Stop order traders making money up and down. But the most recent information we have is this tight bear channel with open gaps. 3-bar micro channel here, open gap. This low and this pullback, the high of the pullback does not overlap the breakout point here. So we have trapped traders there. Big bear breakout here below this swing point. And we can see it does not overlap that breakout point as well. So open gap here, open gap here. Looks like another open gap here going into the day with a fairly tight bear channel with sideways to up pullbacks. So the bears clearly stronger than the bulls here. So we know we're going into the day always in short based on the Globex chart. Now if we just look at the RTH 5-minute chart, all we see is a gap down. Here's yesterday's close, and here's the open of the day. I said yesterday that the market rejected the gap up. So yesterday, over here, the market gapped up and had a bear bar on the open. But it's the opposite today. We had a gap down and a bear bar on the open, which means traders accepted the gap down. In other words, the gap down is a breakout. It's a bear breakout. And bar 1 is follow through. So the gap down, the open of the day is below yesterday's low. So it's a breakout below the prior bar's low on the daily chart, and that's a breakout point. Bars 1 through 3, bears get immediate follow through, and the follow through is strong. The bars are much bigger than the average bar range from the prior day. Price moved a big distance and all the bars closed on their lows. The problem with bar 1 being the current high of the day is that in general, bar 1 remains the high or low of the day only about 20% of the time. So for the most part, you can expect that bar 1 will not remain the high of the day. The probability that bar 1 remains the high of the day after getting strong follow through, like here, 2-3, maybe bumps it up to 50%. But still, in general, bar 1 usually is not the high of the day. And if you think about the context, gap down with follow through, breaking out below yesterday's low, that's a breakout point that may have to get tested. So as strong as this breakout is on the open, we may get a deep pullback testing breakout points and the bar 1 high. 3-bar micro channel 4 through 6, but obviously very weak. We know it's probably 3 legs up on a smaller time frame. We can see because of the tails on bars 4, 5, and 6 that it's 3 push up. But it's enough of a trendline break to disappoint traders down here, meaning bears who sold the close of 3 are disappointed with bars 4 through 6, and that may be an incentive for the bears to look to buy back shorts at break even. Maybe they sell the close 3, scale in, maybe above 3, 50% pullback of the breakout, maybe above a weak bull bar. Wherever they scale in, they're probably looking to buy back short around their original entry, the close of bar 3. So that creates support. But this is still probably a minor reversal. And the odds are the gap down and the breakout follow through down to 3 will probably get a second leg. So we can see the low 1 on 6 failed. There were buyers below and a big second leg up on bar 8. What's the problem with bar 8? couple of things with bar 8. It's a big bar, which is good for the bulls, but big bar means big risk. And look at the amount of overlap with the prior bar. More than half the bar overlaps bar 7. And overlap means the market is probably in a channel or a trading range, not a strong breakout. Also, it's leg 2. Leg 1, spike break, pullback. Leg 2, and it's against the market regime. All the bars are completely below the moving average. So it's possible that bar 8 is a second leg trap, trapping traders into buying too high. But strong enough bar will probably get its own second leg, and the bears need to accumulate some selling pressure before reversing back down. Smaller bar on 9, so weak follow through. Big bar 8, smaller bar 9, not so good for the bulls, and probably resistance at the bar 1 high, yesterday's low, and the moving averages. The light blue dotted line is the 60-minute chart's 20 bar moving average plotted on the 5-minute chart. So resistance at the moving average, bear reversal bar. Any trader that is long for any reason, anywhere they bought, probably wise to exit below bar 10, and then follow through selling on 11 and more selling on bar 12. So a 3-bar micro channel, strong enough breakout for a second leg down. Probably sell the close 12 and scale in. The odds are the gap down and the follow through down bar 3 will get a second leg, and now this breakout 10 through 12 is strong enough for its own second leg. This might be big, leg 2, gap down, and 1 through 3 being leg 1, complex 2-legged pullback, and then this is the start of a big leg 2. Give up bar 12 and 13. 12 was a sell to close bar, market raced to support. Maybe you have trapped bears at the close of 3 looking to buy back shorts, but this is enough momentum and strong enough context that the market's probably not going to stop here, even if it bounces and pulls back. So some hesitation because of that temporary support, but nothing to buy. Are you going to buy above bar 14? Of course not. It's a strong bear micro channel and a weak signal bar, trading range bar. If anything, it's a sell to close bar and sell above the bar, and then more selling. So obviously a very strong bear breakout. Is there any reason to buy here? I don't think so. Especially if you are a price action trader trading breakouts and second legs. The only way you can buy is if there's a bull breakout first that is strong enough for a second leg. And right now we don't have that. The market is clearly always in short. And this is the kind of breakout that you can imagine is kind of like a freight train or an aircraft carrier on the ocean, meaning it just has so much momentum and inertia that it takes a really significant trendline break to reverse it. So you can expect all reversal attempts to be minor. So do you buy bar 18? No. It's a strong bar. The bar itself is a strong bull trend bar, but it's not especially big compared to the bars to the left. And it's not breaking a significant trend line. Maybe there's a trend line break because this is a very tight channel on a smaller time frame, but the reality is that a strong breakout like this is trapping traders above, and that creates a demand for selling and layers of resistance above. So the pullback will probably be relatively minor. So this should be a minor reversal that leads to more down. Maybe 18 is strong enough for a small second leg, but it's not worth trading. If anything, it's worth looking to sell a second leg attempt. So probably sellers at the close of bar 18. Bulls trying to get their second leg, but failing. We're starting to channel down. Channel is tight. The buying pressure is weak, and there's still really no reason to buy. Always in traders holding short. What about 24? It's a wedge. You buy above 24, 3 legs down. 1, 2, 3. Each one triggered, so high 1, high 2, high 3. I think it's a bad idea to look for high 1s and high 2s and high 3s in a bear trend. Again, any reversal attempt here is probably going to be minor. So maybe the bulls get a bounce because of the structure. Small, 3 legs down, maybe a minor reversal. But again, I think we'll have a hard time getting much above here if we get there at all. So probably better to look to sell. As far as being short, maybe you exit above 24, but be ready to sell again below a bear bar. So a little bit of a vacuum test of resistance, but also possible second leg trap, breakout, two-legged pullback, second leg. Remember, every double top must be leg 2. So this is setting up a low 2 short for the bears. So 25, more of a sell to close bar, betting that the bulls will not get very far. They're trapped here, and this is very strong selling, needs a second leg down, and will probably fall for some kind of a measured move. So outside down, 26, market continuing lower. This was a bear flag. It's possible market breaks below it, falls for a measured move. 28, another minor reversal. Maybe it's a good looking bull bar, but when you look to the left, the context is really weak for buying. It's more of a sell to close bar. Couple legs sideways to up, so new bear breakout to new low. Leg 1, pull back, leg 2. So now we have 2 legs against the strong trend. 30 is probably a sell to close bar, kind of similar to 25. And then again, outside down, 32, setting up the low 2 short. Bear breakout, low 1, failed, pulled back, low 2, strong signal bar. Here's a bear trend line, and we have a bear channel. So channels you trade like a trading range that is sloped. So buy low, take profits near support channel line, and sell high, sell near the trend line. So another test of the trend line, better to look to sell. What about here? A 4 or 5 bar bull micro channel breaking above the bear channel, the trend line. Is this strong enough for a second leg? We redraw the trend line. Spike in channel, bear trend, trend line break. Is this setting up a major trend reversal where we test the lows and then form an opposite trend? The trend line break is fairly weak. Each of the bars overlaps the prior bar by at least 50%. You have a tail above on 34, so that's a breakout pullback on a smaller time frame. Second push up to 35, pause 36, and a third push 37. So structurally, this leg from 33 to 37 is 3 pushes up on a smaller time frame. And then here it's 2 legs, maybe it's 1 pullback, 2. It's also a double top with 26. Every double top is leg 2, 1, 2, and it's testing resistance. So remember the last time market was here, we had a lot of selling, and that trapped a lot of traders. So if the bulls bought 25, disappointed 26, what are they going to do? Put yourself in the shoes of a bull. Let's say you bought 24 or 25, and this was the outcome, and you're still holding long. All of a sudden, the market comes back to your entry price. Are you looking to add on to your position, or are you desperate to get out? You're probably, if you're lucky, maybe you're lucky to get out at break even. But if you bought here, you made a mistake. You're buying high in a bear trend. The market is giving you a chance to exit at your original entry. So as far as this, it's a 4 or 5 bar bull micro channel, but it's a late leg against a strong trend, testing resistance. So there's a lot going against it. And because of that, 36, 37, probably more sellers in this area. Trendline break and retest on the same bar. setting up a high 138, probably a sell the close bar. And why is that? Because of the reasons I said before. It's a leg structurally in here, it's 3 pushes up. Maybe it's leg 2 here, testing resistance. So are you really eager to buy at the top of a trading range or a bear channel? No, it's the exact opposite of what traders are doing. And on a smaller time frame, this is a wedge, trendline break, and retest. So on a smaller time frame, 37, some trader bought the close 37, disappointed with their follow through. If you bought here and then suffered this drawdown, you're just happy to get out break even. So that's why I said it's probably a sell to close 38 and sell above the bar. But in these situations, sometimes you don't get the opportunity to sell above the bar. If you try to sell above the bar, it's a little bit greedy, and maybe you just want to sell the close instead, sell the market. And in this case, you can see the sell above, the market did not trade above 38. So there was this sense of urgency to get short on the close of 38, both bulls and bears selling. And this sets up a new bear breakout. Another micro channel, strong enough for a second leg. Bad stop order buy 43, sellers above. 45 is kind of like 18 or 24. Maybe it's a high 2, but it's still a strong bear trend. The upside is limited, so maybe you exit shorts above 45, but be ready to get short again below a bear bar, and doesn't trigger above 45. So if you had to stop above 45, you'd still be short. Still always in short. The bulls have not done enough to reverse the always in direction here. Maybe a measuring gap here. Maybe it's exhaustion. Maybe it's 3 big legs down, gap down to 3, leg 1, leg 2, leg 3. But is this a third leg that you want to fade? Probably not. I can see if you don't participate in selling here because it's 3 big legs down, we're getting far from the moving average. It'll probably pull back soon. But as far as fading it, I would not. I think it's easier to wait for, if you're looking to buy, just wait for a bull breakout and look to capture the second leg. What about buying 51? It reminds me of bar 18. Not especially big, following a strong bear breakout. If anything, it's probably more a sell to close bar. It might result in some profit taking and a correction sideways to up for a couple of legs, but I expect any reversal after this to be minor until the bulls do something impressive, like breaking a strong or significant bear trend line. Bulls get bad follow through. They're getting an attempt at a second leg up, 54, but probably sellers. Now testing temporary support. There's some support here. Some closed bears disappointed with their follow through, so that creates some support. But isn't it enough to reverse this bear trend? Probably not. It's still a minor reversal. So 56, a double bottom, but probably sellers above 56. Here's the double bottom. First reversal, second reversal. But this one, 59, is kind of like 25. Decent looking bull bar, but leg 2 against the trend and testing resistance. So the last time you had that, you had the big outside bar 26. I suspect we'll get something similar here. Even if we go a little higher, the upside is probably limited. This looks like a minor reversal. Where are the big consecutive bull bars breaking a significant bear trend line? They don't exist. So this is probably a minor reversal. 60 testing a little higher. Structurally here, bear breakout, pause, bear breakout, pause, breakout. This is a trading range on a smaller time frame, and that will act as resistance. Trading range, breakout, traps traders. So 60. What about buying 60? It might be a bull trap, second leg trap against the trend, testing resistance, a breakout point. So bulls probably need one more bar. 59.60 look good, but again, they need one more bar to really convince traders. And if they don't get good follow through, traders will suspect it's simply a minor reversal like back here. Leg 1, leg 2, leg 1, leg 2. leg 1, leg 2, testing resistance in a strong bear trend. So weak follow through. Buy the close bulls on 60, disappointed 61. That creates a sell the close signal again. And maybe 62 briefly tested the close of 60, although it doesn't look like it quite got there. And then we continue lower, breaking this bull trend line. We still may get a small second leg up. This might have been enough for a small second leg, but it's still minor and against the trend. So better to be looking for sell setups here. 3-bar micro channel, sellers above 63, and the micro channel growing. Another bear flag may get a measured move down. If the bulls fail in a big way, maybe we get a measured move in the opposite direction of this 3-bar micro channel. And what about buying 66? Is it a wedge bottom? Every breakout of a double bottom is a wedge functionally, so double bottom here, and then breakout of a double bottom, 3 pushes down, you can call it a wedge. But 66, small body following a strong micro channel in a big bear trend. Probably not great for buying. 66, if anything, might be a sell setup. It's a big bar, so big risk. Traders probably setting limit orders to sell above 66 rather than to buy. 66 gets a small second leg. 68 probably sell the close, small second leg against the trend, and this needs a second leg down. And bears trying to get their second leg, finding some support. Maybe we're in a tight trading range at this point, but we're still completely below the moving average. It's still always in short. So even if the bulls get a second leg up, there's still layers of resistance the bulls have to get through, including the moving average. So 3-bar micro channel, but straight into the top of this tight trading range and the moving average, which are resistance areas. This breakout needs a second leg down, so this is probably a bad area to be buying. Bull breakout 74 maybe creates support around the moving average. Now the bulls maybe get a second leg up. Instead, we reverse back down. The bears were too strong here. We're testing resistance to the left. And the bulls never really broke a significant trend line with strength. So as far as this, maybe we're definitely evolving into more of a channel. And the channel will probably evolve into a trading range. Now we've got more clear 3 legs down. We're entering a support area. So downside here, probably limited. 66 low, bottom of the trend, and the bottom of the channel. So reversal up, bulls. This bull breakout got a deep pullback, still got its second leg. So overall, pretty interesting day. And that's going to be it for today's end of day review. So thank you for joining me today, and I hope everyone has a good night.